Hello students, welcome to EPG Pathshala. I am Ritesh Verma from Maharaja Agrasen College, University of Delhi. Today we are going to talk on module Methods of Valuation of Shares from Paper Accounting and Financial Analysis. Learning objectives of this module. What are the various methods of valuation of shares? Like net asset method, yield method, fair value method, and price earning method. Applicability of different methods in different situations. Now, methods of valuation. There are different methods of valuing shares which are broadly classified as follows. Net asset basis or intrinsic value or breakup value method. Earning capacity or yield or market value method. Dual or fair value method. Return on capital employed method. And price earning ratio method. Net asset basis or intrinsic value or breakup value method. This method is concerned with the assets backing per share and may be based either in case 1 it could be when the company is going concern, and case 2 when the company is being liquidated. Now when the company is a going concern, under this there are further different approaches which are as follows. To value the shares on the net tangible assets basis by excluding the amount of goodwill, and to value the shares on the net tangible asset basis by including the amount of goodwill, and assets backing where company is being liquidated. To value the share on the net tangible assets basis by excluding the amount of goodwill. Under this method, it is necessary to estimate net tangible assets of the company, and the value of net tangible assets can be calculated by deducting assets from liabilities in order to value the shares. While calculating the value of shares by this method, care must be exercised to ensure that the figures representing the assets are sound, that is, intangible assets and preliminary expenses are eliminated and all liabilities, whether in the books or not, are deducted from the value of the tangible assets. Non-trading assets are also included in the assets, and the assets are taken at their market value, that is replacement value. Where both types of shares are issued by a company, the shares would be valued as under. If preference shares have priority to capital and dividend, then the preference shares are to be valued at par. After the preference shareholders are paid and the net tangible assets are to be divided by the number of equity shares to calculate the value of each share. If at the time of valuation there is an uncalled capital, that is the capital which is not yet called by the company, then the uncalled equity share capital be added with the net tangible assets in order to value the shares fully paid up. The valuation of shares for the shareholders who have calls on arrears, that is where any shareholder fails to pay the amount due on calls. It will be valued as percentage on their paid up value with the nominal value of shares. If the company has equity share of different face value, the total replacement value of assets after deducting the paid up value of preference shares is first apportioned to different categories of equity shares on the basis of paid up value of such categories. The amount so come would be divided by the number of shares in each of such categories to get the value of each share of such categories. If the preference shares are participating and rank equally with equity shares, then the value per share would be in proportion to the paid up value of preference shares and equity shares. To value the share on the net tangible asset basis by excluding the amount of goodwill. In many cases, goodwill may be worth the figure at which it is stated in the balance sheet, or if there is no book value for goodwill, it may nevertheless exist because it is the good reputation of the company. Further, even if there is a book value, the actual value of goodwill may be considerably higher than the book value. It is generally considered that the value of fixed assets of the company depends upon their ability to earn profits, that is, on the goodwill attaching to them. In such a case, goodwill should be included with other tangible assets for calculating the value of shares. Assets backing where company is being liquidated. Asset backing method is appropriate if liquidation is contemplated, though realizable value should be taken into account. When realization is imminent, it is desirable to construct statement of affairs supported by independent valuation of the fixed assets such as freehold property, plant and machinery, goodwill, etc. Provision should also be made for the cost of liquidation, and thus some indication may be obtained as to how much per share may be payable to right holders. Net asset basis of valuation of shares. Net asset basis of valuation of shares is generally recommended by only those companies where no realistic idea of the earning capacity is possible because of fluctuations in profits and where a large block of shares is to be transferred or when the company is at the stage of winding up. Net assets basis of valuation of shares is also suitable for a company which has been trading at a loss in the past and there are no prospects of earning any profit in the near future. The method of valuation is acceptable for statutory valuation, particularly the wealth tax rules provide for assets basis of valuation of shares. Valuation of shares by net asset basis is not desirable for a growing company. And the major practical difficulty in net asset basis of valuation of shares method is the estimation of market value of assets, as there is a lot of subjectivity in ascertaining the realizable value of assets, which may not give true or fair value of shares. However, this following step should carefully be followed while calculating net assets or the funds available for equity shareholders. First, ascertain the total market value of current and fixed assets. Second, calculate the value of goodwill by applying any method. Third, the market value of non-trading assets is to be ascertained like investment. Fourth, all fictitious assets like preliminary expenses, discount on issue of shares or debentures, debit balance of profit and loss account must not be included. Fifth, deduct the total amount of current liabilities, amount of debentures with area interest if any, preference share capital with area dividend if any. Sixth, the balance left is called the net assets or funds available for equity shareholders. Applicability of the intrinsic value method. For the permanent investors to determine the value of shares at the time of purchasing the shares of any company. Next, when the shares are valued at the time of amalgamation, absorption, and liquidation of companies. Next, when shares are acquired for control motives, this method can also be applied in this case also. Intrinsic worth. It is one of the simplest and logical methods for calculating the true value of shares. It is one of the methods which are mostly used by taxation authorities. In this method of valuation of shares, the present value of goodwill is also considered. This is useful for company going into liquidation as the net realizable value of assets is taken into consideration. Limitations of intrinsic method. For growing company, this method is not suitable. As goodwill is taken into consideration, it is difficult to calculate the value of goodwill as there are number of methods to calculate the goodwill. This method leads to personal bias as the market price of the asset is to be quoted, which is very difficult to ascertain. As this method of valuation of shares includes the intangible assets such as goodwill, trademark, it is not a reliable one. Earning capacity or yield or market value method. There are two ways to compute the value of share under this method of valuation, which are as follows. 1. When valuation is based on rate of return. Second, when valuation is based on productivity factor. When valuation is based on rate of return. The term rate of return here means a return earned by shareholders on his investments. The rate of return can further be classified as A. Rate of dividend, B. Rate of earning. Rate of dividend. This method of valuation of shares is suitable for small blocks of shares because financially weak shareholders are usually interested in dividends as their only source of income is dividend. The term dividend means the part of the profit which is distributed among shareholders. The value of share according to this method is ascertained as below. Value of share. Here, the value of share is equal to possible rate of dividend divided by normal rate of dividend multiplied by paid up value of share. Rate of earnings. This method of valuation of shares is particularly suitable in case of big investors because they are more interested in company's earning. They are not interested in what the company distributes in the form of dividends. The value of share according to this method is ascertained as follows. Value of share is equal to possible earning rate divided by normal earning rate multiplied by paid up value of shares. Rate of return basis of valuation of share is the method which is to be used in all but exceptional cases. Under this method, the valuation depends upon the comparison of the company's earning capacity and the normal rate of profits or dividends that is current on outside investment. To ascertain the value of share based on profit earning capacity, future maintainable profits and normal rate of profits or dividends at which the profits are to be capitalized must be fixed. In arriving at the profit to show the normal earning capacity, generally the following adjustments are made. Number one, non-recurring item should be allowed for. Number two, income tax charges should be appropriated to the particular years in which they are paid. Number three, allocation to reserve. The main purpose of adjustment of profit in the determination of future annual maintainable profit, which can be used for distribution as dividend. The rate of interest for capitalizing the average normal profit is fixed upon the circumstances of a particular case. Generally, at the rate of 10% or more may be reasonable. Following steps may be followed for calculating the value of shares according to yield method. Step number 1. Calculation of average expected future profits. Step number 2. Calculation of expected return by following equation. Expected return is equal to expected profits divided by equity capital multiplied by 100. Step number 3. Calculation of yield value of share is done with the following formula. Value of share is equal to expected rate divided by normal rate multiplied by paid up value of share. Valuation based on productivity factor. Productivity factor means the earning power of the company in relation to the net worth of the company. It is calculated as follows. Productivity factor is equal to average weighted tax profit divided by average weighted net profit multiplied by 100. Average profit and average net worth are ascertained by taking a number of years whose results are relevant to the future. Productivity factor as calculated with the formula just discussed is applied to the net worth of the company on the valuation date of shares to arrive at the maintainable profits of the company. The projected earnings after necessary adjustments, if there are any, such as dividend on preference shares, effect of underutilization of productive capacity, making appropriation for rehabilitation and replacement purposes, are divided by the normal rate of return to arrive at the value of company's business in relation to the equity shareholders. The value of company's business so obtained is divided by the number of equity shareholders to get the value of each equity share. Earning capacity worth. This method is most reasonably accepted, being this method is based upon comparison between expected rate of return and normal rate of return. This method is useful in case of minority holdings since they are interested in the profits earned by the company. It is best suited to a company which is a going concern. Earning capacity method limitations. Difficulties may arise while selecting the normal rate of return. The values of net assets of the company are totally ignored. This method is not suitable for the company which is going into losses for the past few years. This method contains various difficulties while application of this method. Predicting the future maintainable profits is difficult to ascertain. For example, from the following information, calculate the value of an equity share. The paid-up share capital of company consists of 1,000 15% preference shares of rupees 100 each and 20,000 equity shares of rupees 10 each. The average annual profits of the company after providing for depreciation and taxation amounted to rupees 75,000. It is considered necessary to transfer rupees 10,000 to general reserve before declaring any dividend. The normal return expected by investors on equity shares from this type of business carried on by company is 10%. Solution to the problem. First of all, we'll prepare two columns. One is of particulars and second is of amount column. In particulars column, we'll write average annual profits after taxation, which are 75,000. So in amount column, we'll write rupees 75,000. We'll deduct transfer to general reserve from this amount, and we'll also deduct preference dividend at the rate 15% on 1 lakh from this amount. So we'll deduct total 10,000 plus 15,000 from 17,000, which will be rupees 50,000. So profit available for equity shareholders is rupees 50,000. And expected rate of return is 50,000 divided by 2 lakhs. 2 lakhs basically equity capital into 100. So it is 25%. It comes at 25%. So value per equity share is equal to expected return divided by normal return and multiplied by paid up value of equity share. So value per equity share comes at 25 by following this method, that is 25 divided by 10 into 10. So answer is 25. Dual or fair value method. Many accountants are of the view that neither the net assets basis nor the earning basis of valuation of shares is correct. But the fair valuation method may be an average of the two methods of valuation of shares. The formula for the valuation of shares according to the dual method or fair value method is as follows. Value of share is equal to value of shares on net asset basis plus value of shares on earning basis whole divided by 2. Since this method takes the average of the values obtained in net asset basis and earnings basis, it makes attempt to minimize the demerits of both net asset basis and earning basis methods. Example: calculate the fair value of share of the company from the following information. 1. Net assets available to equity shareholders rupees 2,82,500. 2. 2,000 equity shares of rupees 100 each. 3. The normal rate of dividend declared by such type of companies is 15%. 4. The average rate of dividend declared and paid by this company is 18% on its paid up capital. Now, solution to this problem. Value of equity shares according to yield method. Value of share is equal to rate of dividend divided by normal rate of dividend multiplied by paid up value of share. So value of share in this case is 18 divided by 15 multiplied by 100, that is rupees 120. And now value of shares on the basis of net intrinsic value. Value of share is equal to net assets available to equity shareholders divided by number of equity shares. So number of equity shares are 2000 and value of shares is rupees 2,82,500 divided by 2000 and value of share comes at rupees 141.25. Now fair value of equity shares. Here value on the basis of yield plus value on the basis of net assets divided by 2. So value of share as per this method arrives at rupees 120 plus rupees 141.25 divided by 2, that is equal to rupees 130.63. Return on capital employed method. Under this method, valuation of share is made on the basis of rate of return to be considered after tax on capital employed. Rates of return are taken on the basis of predetermined or expected rates of return which an investor may expect on the investments. After ascertaining these expected earnings, we are to determine the capital sum for such a return. Following steps should be followed to compute the value of share. Step number 1. Ascertain the maintainable expected profits after all adjustments, if any. Step number 2. Ascertain the normal rate of return on capital employed for a similar business. Step number 3 and last step, on the basis of our expected rate of return, maintainable profit is to be capitalized. Price-earning ratio method. This is the ratio which relates the market price of the share to the earning per equity share, and it is calculated with the help of following formula. Price minus earning ratio, that is PE ratio, is equal to market price of a share divided by earning per share. So students, let us summarize what we have learned in this module. Net assets basis of valuation of shares is generally recommended by those companies where no realistic idea of earning capacity is possible because of fluctuations in profits, and this method of valuation of shares is also suitable for a company which has been trading at a loss in the past and there are no prospects of earning any profits in the near future. This method of valuation of shares is suitable for financially weak shareholders who are usually interested in dividends. It is best suited to a company which is a going concern, since fair value method takes the average of the values obtained in net asset basis and earning basis. It makes attempt to minimize the demerits of both net assets basis and earning basis methods. Thank you.